Chapter 12, we're going to briefly discuss some of the strategies and concepts with tax planning. Very short chapter, but obviously we need to discuss some of the basics of moving money, moving deductions, moving income itself in order to minimize our overall tax burden. And there was some famous person, I don't know who it was, and I don't want to take credit for anybody saying things, but basically said it is every American's obligation to pay the least amount of tax that they have to pay. So find out how much tax needs to be paid. Don't pay any more, but obviously don't pay less than what you owe. There are essentially 5 different strategies to involve. A deduction. Here's where we want to accelerate deductions allowed under the current laws. So move deductions that maybe you could take next year or the year after and move them into the current year. I mean, some of these deductions are actually taken or moved, if you will, at the very end of the year. So you want to sneak them in before the end of the tax season. Diversion talks about where we move money into investment money into securities or some type of another asset that's going to have a lower tax rate or maybe even escape taxation. Deferral means where we're going to defer taxation into future years. This is essentially what we do with retirement programs. Deflection is when we shift tax to someone that has a lower tax rate. And diminution is where we reduce taxes through various kinds of strategies. They could be investment strategies. They could be just transactions that we take that ultimately reduce taxes. So we're briefly going to discuss some of these strategies. What about deductions? There are a lot of deductions that people, quite frankly, forget. They forget about medical expenses. I mean, the actual rule is, if I'm not mistaken, you can only deduct anything over 5% of your AGI. So some people just say, well, I'm sure I'm not over 5%. I make too much money. 5% is too high of a number. But from time to time, you actually have more than that 5%. And the point is, once you add all of these itemizable deductions together, you may exceed the standard deduction. So you don't want to forget any of these. Flexible spending arrangements. If you have a flexible spending account, don't forget to take the deductions for that income. Moving expenses. You can always deduct moving expenses. Tax deductible interest, right? If you have any equity income, you can, or equity interest payments, you can deduct that from your income. Business expenses and rental expenses. They have their own special kinds of codes and rules that go along with this. Now, most business expenses are going to be taken care of on a Schedule C for a sole proprietor. But there are other business kinds of expenses that aren't included there. For instance, if you work for a company and they don't, you have a business account, but they don't reimburse the entire business account. That's not Schedule C income. That is what's referred to as other business expenses, and that's for non-reimbursed things. So we need to keep track of those expenses so that ultimately we may have some deductions that we can take. And likewise, rental expenses. You have a property that you are renting out. As long as you stay there for less than 14 days or 10% of the days that it's rented out, as long as you fulfill those rules, you can deduct rental expenses. Diversion. Right? So now we're talking about using municipal bonds, the tax shelter idea, transferring income generating assets to children. Right? Move that money to children. Charitable donations, tax-free Social Security benefits. This is just a way of what? of essentially moving this income to another place, right, that has either different tax rules, which require different taxable tax rates, and or just moving the assets to other people. Tax deferrals could be done with either pre-tax dollars or after-tax dollars. Most of us are associated with the after-tax dollars. We have insurance contracts, non-deductible IRAs can be after-tax dollars, Roth IRAs, variable annuities. These are all things that are done after our paycheck, and they are deferred income. Deferral with pre-tax dollars is the stuff that we do that is the qualified kinds of plans that we'll talk about in some later chapters. With respect to the IRAs, though, there are certain limits to how much you can deduct. And it depends on whether you have a retirement plan at work or not. So if you have a retirement plan at work and you are married filing joint, if your AGI is $92,000 or less combined, then you can deduct the full, in this case up to $5,000 from your income. But if you make over $112,000, of that $5,000 you get no deduction. So instead of it being a traditional IRA, it is now a non-deductible IRA. Anywhere in between the $92,000 and $112,000, you get partial deductions. And if you see here, the difference between that is $20,000, right? There's $5,000 difference, so essentially every $4,000 you lose $1,000 of the deduction. What happens though if, oops, I'm sorry, I skipped into, if you're not covered at work? Well, if you're not covered at work, the balance, the maximum is $183,000. So if you don't have a retirement plan, you can, and your income is less than $180,000, parts of your IRA will certainly be deductible from income. And in fact, if you have $173,000 or less of income, the full amount is tax deductible. So again, we want to be able to separate what is deductible and what's not deductible. Now, what I might add though is if you have any income that ultimately is not deductible, you don't want to do a traditional IRA. You would rather do a Roth IRA so that you don't have to record and bookkeep these differences through time. Quite frankly, most people that are saving for retirement will not do traditional IRAs if they're doing stuff outside of work. They will use a Roth IRA because of the tax benefits. Again, we'll discuss that in later chapters. Deflection is moving income to other people. What if you were to take and move, you have a let's just call it a business income, and you move that to your kids. Well, you're at a 35% tax bracket, but with this income, your kids are only at a 15% tax bracket. Well, instead of paying the tax, the kids pay the tax, right? Well, that's not exactly true. If you move income to a kid, the first $850 is tax exempt. There's no tax on it. The next $850 is taxed at the child's tax rate of 10%, but then after that, it goes to your marginal tax rate. So you really can't escape income by moving income or taxation by moving income to children. It just really doesn't work. We could obviously give gifts. We could give assets away. But of course, if we give them away, we no longer own them. So we now no longer have rights to those assets or their income. Child employment, of course, we could always just hire our children to work for us, pay them an income, and then have that as a deduction because they're working for us. Diminution is something a little bit more difficult to kind of think about, but essentially this is where we are creating and using strategies to remove income. For instance, a charitable contribution. If we give away appreciated property, the value of the thing that we give away is not our basis in the asset. The value of what we give away is its appreciated value. So we will escape the capital gains tax on that appreciated property. We can accelerate interest deductions. If maybe, we're going to have to pay interest, maybe instead of paying the interest in February or March, what happens if we just write the check and pay it in December, a couple of months early? Well, then we get to take the interest deduction this year instead of next year, so we can accelerate some of the deductions we have for income. And again, there's a variety. As you read through the text, they'll describe some of these techniques in a lot more detail. So finally, right, we just have, just some golden rules and try to get to financial independence, right? There are really 6 keys to success. Live within your means. Don't borrow. Build up an emergency fund so that when bad things happen, when the rainy days get here, you have money to cover those occasions. Start saving as early as you possibly can. Pay yourself first. You're certainly thinking about retirement planning. You should put away or have at least 10% of your income put away every month. That's just from retirement. In addition to that, it would be nice if you could put away another 5% or so to ultimately save for those things that you want to buy instead of having to borrow to buy. Make sure you reach out for higher returns. Try to find those assets that provide better returns on invested dollars. And in the end, just know the limits of your knowledge. Don't invest in things that you know nothing about, right? Try to find things that you're familiar with. If you're not familiar with things, then you need to seek the guidance of a professional. So that's the end of chapter 12.